Hi, my name is AKIF ZAFRAN bin Muhamad FAZLY from BA 44D. So I will explain to you about the question 1. This question 1 is from chapter 2, which is depreciation and taxation. So let's answer the question A1. Construct the SYDM depreciation schedule for the machine. First, we need to identify the cost of asset. In the cost of asset, it have purchase price, which is 52,000 ringgit, freight or transportation 3,300 ringgit, and installation 2,700 ringgit. So the total of the cost of asset is 58,000 ringgit. The useful life is 6 years and the salvage value is 12,000 ringgit. After that, we need to calculate the sum of the year by using the formula n plus 1 divided by 2. So that is 6 plus 1 divided by 2 equal to 21. Thus, to get annual depreciation, the formula is rate multiplied by cost of asset minus salvage value. So the cost of asset minus salvage value is 46,000 ringgit. For the last step, we need to draw a table from year 0 to year 6. First, we need to put the total cost of asset at the book value after depreciation at year 0, which is 58,000 ringgit. To get the amount for annual depreciation, the rate must be multiply the 46,000 ringgit. So for year 1 until the year 6, we must do the same way to get the total amount for annual depreciation. For the accumulated depreciation, just add the amount of annual depreciation year after year to get the amount for accumulated depreciation. So to get a book value after depreciation is book value after depreciation year before minus by the annual depreciation. Move on to the question A2. Calculate the total tax liability that the company has to pay. So the total of cost of asset is 58,000 ringgit, useful life 6 years, salvage value 12,000 ringgit, annual depreciation 7,666.67 ringgit, book value 33,904 ringgit, and selling price 35,000 ringgit. So to calculate the total tax liability, there are a few steps on total tax liability. First, gain on recapture depreciation by selling price minus book value. So the amount is 1,096 ringgit. Next, tax on recapture depreciation. So the amount of gain on recapture depreciation multiplied by marginal tax rate. So the amount is 383.60 ringgit. After that, tax on ordinary business income. To calculate that, we must calculate the earning before tax multiplied by the marginal tax rate. So the amount is 26,250 ringgit. So the amount of total tax liability is 26,634 ringgit by adding the amount of tax on recapture depreciation and tax on ordinary business income. So let's answer the question B. First, we must list down the total cost of asset, useful life, and salvage value. The total cost of asset is 510,000, ringgit and useful life is 5 years and salvage value is 50,000 ringgit. After that, to know the rate in this question, we must determine annual depreciation based on straight line method. By 100 divided by useful life is 5 equal by 20. So the result step 1 must be multiplied 2. So the rate is 40%. After that, make a table like as usual. But at the table we can see at the year 5 it's something wrong at the book value after depreciation because the amount is not same with the salvage value. So we must adjust the table. To adjust the table, the amount of book value before depreciation must be minus the salvage value. So 66,096 ringgit minus by 50,000 ringgit. So we can get the amount is 16,096 ringgit. After adjust the annual depreciation in a new amount, so we can get the book value after depreciation is 50,000 ringgit, same as the salvage value amount.
Hello, my name is Muhamad SYAFIQ bin Muhammad SHAHRIL from BA 11440. Today I will explain question 2. Based on the information given for question 2, we have the probability and return for both project MCMC and Cyberjaya. First question, we need to find the expected return by using this formula. We can find it by sum all of the result of probability multiplied to return. We need to make sure that we use the right amount of probability and return based on the type of project. Next, after we find the expected return for both projects, we can use that answer to find variance. It can be done by using this formula. Lastly, the coefficient of variance. It can be found by dividing the standard deviation and expected return. After we have find all the answer, we can put it in the table. Okay, then next is question number 2. Assume that QCQ Digital is risk-averse company. Explain which project should the company accept. As we can see, these two information is related in determining the risk for each project. Lower SD translate into higher probability distribution and hence lower risk. The coefficient of variation is better measure for evaluating risk in the event of alternative investment differs in risk and expected return. So using the answer, we can conclude that if QCQ Digital is a risk-averse company, it will choose Cyberjaya project because it has a lower standard deviation compared to project MCMC. The coefficient of variance for project Cyberjaya also has a lower amount compared to project MCMC, means that the lower the coefficient of variation, the lower the risk. Okay, next question 2B. Tobishi Incorporation is a producer of electrical appliances. Just released new educational tablet which is selling at an average price of 230 ringgit per unit. The company incur a fixed operation cost of 560,000 ringgit per annum. The variable cost for this same unit is 120 ringgit per unit. From the text, the information we can gather are the fixed cost, price and variable cost. Question number 1. Determine the break-even point in quantity. To find the break-even point in quantity, we can use this formula. Fixed cost divided to price minus variable cost. Then we get the 3,500 ringgit. Next is question number 2. Compute the ringgit sales volume the firm must achieve in order to reach the break-even point. It can be found by using this formula. Fixed cost plus break-even point quantity that we get from the answer number 1, then multiply to the variable cost. So we get the answer 980,000. Next is question number 3. What would be the firm profit or loss if the firm total production and sale is 20,000 units per annum? So to find the profit, we can use this formula. Use the 20,000 as the new break-even point quantity. Then lastly, we get the answer 2,640,000.
Hi, Assalamualaikum. My name is Muhammad Aiman bin ROSFRIDIN. In this video, I will present about question 3, which is based on chapter 5. In this question, there are 5 steps to answer this question. For the step 1 is, we need to determine the weighted for each source, which is for debt is 40%, for preference stock is 10%, for common stock is 50%. For step 2, we need to determine the breaking points. How to get breaking point? To calculate, we need to divide the biggest amount at each of range of financing with weight for each of source of capital. The next is we need to arrange range of financing. To arrange, we need to put the lower amount to the higher amount. For third step, we need to calculate the individual COC. For this question, we do not need to calculate the individual cost because it has been given in the question. For step 4, we need to prepare a WMCC schedule. For range of financing, we have to refer to range of financing at step 2. How to get WACC? To get WACC, we need to multiply the weighted with individual cost, and we need to plus WACC for each of range. For step 5, we need to prepare investment opportunity schedule IOS. To calculate accumulated investment, we need to plus the investment amount with the amount before. For example, the accumulated investment project A plus accumulated investment project B, and so on. For question D, we need to choose the better project. So, we need to draw a graph. The better project is higher than WACC. So, the answer is project A, B, and C can be selected because the rate or return is higher than WACC.
Assalamualaikum. My name is Muhammad HAZEEM EZARIQ bin MOKHTAR from the class BA 114D. Today, I'll be explaining about question 4 for the group simulation FIN 320. For step 1, we must calculate the EBIT indifference level associated with two capital structure. We take the data from the question to calculate our present structure. On interest on debt, we take the debt value times the cost of the debt. The preferred stock is 0. For the number of common stock is divided by par value. Move on to step 2. We calculate the expected financial for each plan. We calculated the alternative 1 and alternative 2 plan the same as before. Use the same formula. For step 3, we substitute the key financial data in the base formula. The formula is EBIT minus interest times 1 minus tax, then minus the dividend preferred share and divide with the number of common stock. After the calculation, as in the table, the EBIT that I got is RM171,928.57 cents. For question B, calculate the EPS for both structures at the EBIT indifference level. The total amount of each must equal because it determines by finding the level of EBIT that provides the same EPS for two financial plans. For question C, from question B, I will plot the points and show the point of indifference POI. I will be using RM 100,000 for lower end EBIT and 300,000 for high end EBIT. After plotting the graph, we can see that the line is crossing one to another at 0.391. For the last question, which structure should the company accept if the company expects its EBIT to be 600,000? As the calculation in the table showed above, the company should choose capital structure alternative 2 because it has higher EPS value compared to capital structure alternative 1. Thank you.
Assalamualaikum and hello everyone. My name is ILYAS bin Amri. I'm from TBA 1144D. My matrix card number is 2019254808. For this section, I am going to give an explanation on how to answer question number 5. This question is actually based on the 7th chapter of our syllabus in Fin 320, which is merger and acquisition. Without further ado, let's start it out. First and foremost, the question is about Aidil Berhad is planning to acquire Fitri Berhad. In a merger transaction, below are the balance sheets of the companies before the merger. The first thing we need to do when we encounter this kind of question is to plot a table as shown above. It would be easier and properly organized to calculate the market price, number of stocks and net income for both companies. According to the question, we identified that Aidil Berhad is the surviving company while Fitri Berhad is the acquired company. The first question requires a calculation on exchange ratio based on earnings per share and market price. The formula for exchange ratio based on EPS calculation is by using EPS TC and EPS AC. EPS TC is divided by EPS AC and the answer we'll get is 0.9. Meanwhile, for exchange ratio based on MP, we divide MPTC and MPAC. The answer for it is 0.45. Moving on to the question C1, we have to calculate the purchase price of Fitri Berhad. The formula is MPAC multiplied by ER multiplied by NOSTC. It is highly recommended to calculate in the bracket first, then multiplied by MPAC. The correct answer should be 2,160,000 ringgit. The next part, question C2, we have to provide the post-merger EPS for both companies. The formula for EPS AC is NIAC plus NITC divided by NOSAC plus NOSTC multiplied by ER. As shown above, the calculation is 600,000 ringgit plus 1,080,000 ringgit divided by 300,000 ringgit plus 600,000 ringgit multiplied by 0.45. The answer should be 2.95 ringgit. Meanwhile, for EPS TC, the formula is post-merger EPS for AC multiplied by ER, which is 2.95 ringgit multiplied by 0.45, and the answer should be 1.33 ringgit. As we can see, the table above shows EPS before and after merger. For question C3, we have to provide a post-merger balance sheet. We have to calculate few items first before preparing the post-merger balance sheet to ensure it is balanced. Firstly, we have to calculate net worth TC and will be used later for new goodwill. Net worth TC is a total sum of 600,000 ringgit plus 500,000 ringgit plus 800,000 ringgit, and we will get 1,900,000 ringgit. Next, the formula for goodwill is purchase price minus by net worth TC, which is 2,160,000 ringgit minus by 1,900,000 ringgit. The answer should be 260,000 ringgit. After that, the formula for common stock is NOSAC plus NOSTC company received multiplied by par value AC. The calculation is 300,000 ringgit plus 270,000 ringgit multiplied by 2 ringgit, and the common stocks will be 1,140,000 ringgit. Lastly, we have to calculate the additional share premium. The formula is MPAC minus by par value AC multiplied by NOS2 received. The calculation is 8 ringgit minus by 2 ringgit multiplied by 270,000 ringgit, and the answer is 1,620,000 ringgit. Therefore, the share premium after post-merger is equal to additional share premium plus Ideal Berhad share premium. We will take the surviving company share premium. The answer will be 2,120,000 ringgit. The table above is the post-merger balance sheet under the purchase method. We include all value from the question. The goodwill is put under assets. The new value for common stocks and share premium are put under total liabilities and equities. Based on the table above, the balance sheet is balanced with a value of 5,660,000 ringgit.
I lost my mind.